From Kansas State University, this is Agriculture Today. Eric Atkinson with you. Here's what's coming up. K-State's Dan O'Brien will remark on this volatile week in the grain markets, stemming, of course, from the ongoing battle in Ukraine, noting that the damage that's already been done in that key grain production country will likely resonate in the markets for quite some while, says Dan. We'll also hear from K-State's Jenny Ifft, as she'll talk about finalizing those crop insurance decisions for spring-planted crops, with the enrollment deadline coming up in just over a week. Jenny will talk about how the just-released RMA price numbers for February will influence the revenue insurance guarantee. And standing by to cover the Kansas agricultural weather scene, K-State's Chip Redmond. All that right here on this Agriculture Today. You're listening to the K-State Radio Network and Agriculture Today. Welcome once more. Well, the grain market's ultra volatile, as we know in recent trading sessions. At the hub of it all, of course, the ongoing conflict in Ukraine. Dan O'Brien along. Dan is a grain market economist, K-State Research and Extension, joins us each Friday right here. Dan, unworldly wheat prices passing $11 this week. If one's holding old crop wheat right now, they might be in the gravy.
These are serious times, particularly in the wheat market. Lots of concern about what's likely to happen in Ukraine and Ukraine agriculture and their logistics and their ability to produce for the foreseeable future, much less move grains out of their ports. So with all that turmoil, we see uproar in the wheat market in particular, but some of that's bled over also into the corn market and the oilseed soybean market. Corn market, because Ukraine's the number 4 corn exporter in the world, and into the oilseed market because their sunflower crop is important also. So you have all those issues, much less with the impact of financial sanctions, trade sanctions, whatever, upon Russian crop availability could also be. So just amazing to see, and we try to track Kansas cash prices and cash prices for wheat across the board at these places we've been watching. Colby cash price $11.15, Salina $11.30 in Topeka, Garden City $11.30 in Hutchinson $11.05 in Columbus, and those aren't soybean prices. Those are wheat prices. We have some bids for new crop for wheat, but there are at least discussion about the potential lack of availability of forward bids for wheat. Now, of course, it's 6 of one, half a dozen of the other deal, in that, we may or may not have forward bids available, but with all the drought conditions that are occurring in Kansas and until rain comes expanding to cover the whole state of Kansas, according to U.S. Drought Monitor, all of Nebraska, all of Iowa now, northern tip of Illinois up into Wisconsin, of course, South Dakota, North Dakota, at least western halves of that, and all of Texas, all of Oklahoma. So what a year to have dry conditions right on top of all this other uproar. These are times that perhaps we're always on the cusp of times like this with 30 days of dry weather or something happening. But this just drives home how risky providing food supplies for the world population can be when you have just a few issues come into play. And boy, they sure have right now.
Of course, we would all like to see a swift resolution to the matter at hand in Ukraine for the betterment of those people there. But it's a market factor nonetheless that can't be ignored. Dan, you have put together some information in your notes this week. You have been taking another look at those prices that were posted by the USDA in its annual Outlook Forum previous week, and making a contrast here between those and what you describe as futures-based price forecasts. And let's walk through those.
Yeah, and in fairness to the USDA, a week ago, there were some thoughts of markets that may be behaving like this, but especially in the wheat, we've had tremendous runs to the higher side. Start with corn. The USDA projected first for the current marketing year and then for the new one new one that'll start for corn on September 1st at 22-23 marketing year. They projected old crop $5.45, new crop at $5. I was really wondering about that $5 number. That seemed to be pretty low given what's been happening in the markets.
Right.
So I went in and looked at what futures for this marketing year and out into that next time frame would be, assuming current basis levels would proceed out into 2022. So we had a 583 futures-based forecast for this marketing year to match the 545 the USDA did, for the old crop that'll end August 31st. And then when you look at the new crop starting September 1, USDA's projection of 5 is matched by what seemed to be about a 553 price for the future. So you've got a situation where the USDA seems to be low given what's happened since that conference, and they probably, coming out of those conferences, they have a track record of being conservative and assuming normality. Well, again, we're kind of throwing that out the window right now.
Right.
I would say also for grain sorghum, the USDA projected also 545 for the current marketing year, 490 for the next marketing year, but that's really where these futures-based forecasts part ways. On grain sorghum prices for the current marketing year that we're in, 621. So kind of what the futures-based forecast would give you, and $6 per bushel for the coming marketing year. Of course, that's all dependent on exports holding up, and particularly with China. So that's probably part of the caution on USDA's part. Went in and looked at wheat also, and that's really where things have changed. The USDA projected a tremendous price. Current marketing year, $7.30. That'll be ending May 31st, June 1. For that next marketing year, $6.80. Given what's happened here of late, the USDA number seems to be low relative to what the futures are thinking. Basically $8 for the current marketing year to finish up, and a number over $10 for the next marketing year. So what a tremendous change to say that, gosh, 1070, 1077, 1080, heading towards 11 would be the price you'd expect for wheat. Is a complete surprise given where we were about 30 days ago. But yet what's happened, that combined with drought, who could doubt that could happen? Finally, to finish up on soybeans, actually the USDA numbers and futures numbers are really pretty close to one another on the soybean market. They're both really good, but to me, it's almost a surprise given that we've just seen $17 soybeans for the lead contract in the last few days. But the USDA projected for the current marketing year that we're in $13. The next one, $12.75. Futures-based numbers, as we calculate them, you got about $13.14 to $13.11. So arguably from 14 to about 40 cents higher on the futures side. To me, that's almost a surprise. But what you're seeing in the futures is a tendency for the upfront contract to reflect all this volatility, but then the market implicitly stating that they believe things will calm down. Apparently this war will come to an end over there, and the roiling effect on the markets will go away. So you saw this in the wheat. We had one day where the lead contracts were up 75 cents during the day, and then you went into the deferreds in July, September, December, and one of those contracts was down 45. So basically a tale of two minds in terms of the current impact versus what they expect to happen down the road. And frankly, the markets are betting, given some of these numbers, that there'll be a resolution to this and things will get back to normal to some degree. We could have a long talk, and probably will sometime, about what's happened to the infrastructure in Ukraine, whether they'll be able to plant crops, whether they'll be able to harvest what's out there in terms of wheat already. And if they do, then who will be there to move the grain, depending on how this conflict comes out, who's there to own the machinery to make it all happen. So just a lot of roiling up of questions and uncertainty, and it's certainly affected the ag markets at this time.
What you said right there gets at that $1 million question, Dan, whether the markets, upon the resolution of the Russia-Ukraine situation, will drop swiftly, much as they rose rapidly in the wake of this. And in that there's been damage done, regardless of when this is resolved, that may carry weight in the markets, you say, for some time.
If there's any segment of these populations around the world that's resilient and has a pattern of defying the experts and surprising them in terms of what they can get done, it's the ag sectors. But there are big issues here going on, tractors, roads, machinery repairs, machinery fuel,
ports,
access to the ports, all these other things, all in play. And depending on how that issue over there works itself out, how functional will the agricultural sector of Ukraine be after all this is done? And Ukraine tends to rank fourth in, I think, corn exports, wheat exports. It's a big player in all these things. And so one country being knocked out, or at the threat of being knocked out, has had all this impact on all these markets.
And finish up briefly on exports. Are we seeing evidence of this distorted effect from the Ukraine war in those trades right now?
Corn is running ahead of pace to meet the USDA's projection. So, here we have a WASDE report coming up on Wednesday, the 9th. I don't know that in that report yet you'll see the USDA make major changes in their export numbers, but strong corn exports probably going to lead to tighter ending stocks coming out of this marketing year, tighter beginning stocks starting the next. So that's a big deal. Grain sorghum's been up and down, had a great week last week. It's so weak again. I bet, again, that's sort of their pattern, up and down. Wheat exports, after a tremendous week for the week ending the 17th, going to return to their normal pattern, about 13 million bushels for the U.S. overall. But I don't think that the market is trading current exports for the United States. I think it's trading what they fear would happen if Ukrainian wheat's unavailable, and that's where that number's coming in. I would say also for soybeans running ahead of pace, also to meet the USDA's projection, so probably some tightening up in this old crop marketing year for that as well.
Historic times in the grain markets right now, and we would ask you to take a look at Dan's notes on the markets for this week. He regularly posts those on the agmanager.info website out of K-State. Dan, thanks as always. Next week we'll talk markets once again.
Thanks, Eric. Take care.
He is a grain market economist with K-State Research and Extension. That's Dan O'Brien, and we'll return shortly with more for you on Agriculture Today. Agriculture Today is back now with still more for you crop producers as an important deadline looms. A week from this Tuesday, March the 15th, is the final day to enroll your spring planted crops in the Federal Crop Insurance Program. You're likely aware of that. But there may be some last-minute considerations you might want to factor into your ultimate final decision on that coverage. And we brought back by Jenny Ifft. She's a risk management specialist with K-State Research and Extension. Jenny, timely in that just a couple of days back, the USDA and Risk Management Agency announced the prices for grains established for the month of February, which serve as an important basis for coverage here.
Yeah, the final projected prices were released, and they are higher, almost at their highest levels ever, actually. Corn was $5.90 per bushel. Last year it was $4.58 per bushel. We didn't think $4.50 per bushel was too bad last year either. If you look at 2018 to 20, prices were around $4 per bushel for corn. It's similar for soybeans. Soybeans are at $14.33 per bushel. Soybean projected prices were $11.87 in 2021 and around the $9 to $10 range from 2018 to 2020. It's similar for grain sorghum as well.
Tremendous numbers right there. What does that mean? Well, it plays right into the guarantee for the producer, and that's the pivotal point here.
Right. So when you have higher prices, and I should say we also have higher implied volatilities. I don't think anybody's surprised that markets are volatile right now.
Right.
And both of those translate into both higher premiums and a higher crop insurance guarantee. So if producers are sticking with the same policy, their prices are going to go up. What they get for that is a higher guarantee. So I pulled a couple specific examples. If you're growing irrigated corn in Finney County, 225 bushels per acre, last year you would have paid a premium of $11 per acre for a guarantee of about $770 per acre. This year, you're going to be looking at $14 per acre and a guarantee of about $1,000 per acre. So a couple more dollars per acre, a couple hundred more dollars of guarantee. So that extra premium is covering you at a higher level.
And that was for irrigated corn in southwest Kansas.
Yep.
You have a dryland example as well?
Yes, I pulled an example from Nemaha County for non-irrigated corn, 150 bushels per acre. So in 2021, your liability or your guarantee would have been a little over $500 per acre, and you'd have been paying $13 per acre in premium. This year, you're looking at a guarantee of about $660 per acre at a cost of about $18 per acre. So those premiums could be $4 or $5 per acre more expensive easily for that additional guarantee.
Right. Well, this becomes highly important in the face of extraordinarily high crop input expenses likewise, right?
Right. And I've looked at the crop budgets and the crop insurance guarantee, and it's almost, I mean, again, these are averages, but at the average, your expenses are almost equivalent to that 70-75% crop insurance guarantee. So this year, the standard RP policy, 70-75%, can cover average expenses.
It's important that that happen, obviously, for producers, but we're not sure what's going to occur with any given cropping season here. So in terms of finalizing the absolute decision on that coverage, you propose several what-if scenarios regarding price and yield, Jenny.
Right. So when I think through, what crop insurance is doing for the producer, I like to think about potential outcomes. Mm-hmm. So one outcome, the best outcome, is that prices go up and yields go up. You have higher revenue than you've expected, a high income year. This doesn't happen all that often, but it's a good outcome for producers. And this is where you have to remember that this is insurance. So you didn't need it in this kind of a year. Your revenue went up, but what you were predicting, again, is this other years when revenue does go down. Mm-hmm. Another one that you could think about, a situation where your prices are going up, but your yields go down. And this is where the harvest price option becomes more important. So with the harvest price option, your crop insurance guarantee resets when prices go up. The most typical example of when this is important is when there's a widespread drought. Mm-hmm. So widespread drought, you have yields go down almost everywhere, prices are higher. And so that's when you still get that crop insurance protection.
And when we think about the price side, with what's going on with the markets right now, that also comes into play here.
Right. So I think this year, another way to think about HPO is with our current global conflicts, prices are going up, even beyond the projected prices that we just talked about. So you could have a situation where you have a local yield loss. So there's no widespread drought in Kansas. This is very common. Prices go up from even more than where they're at. Your guarantee is going to reset at that higher price level. So your loss under a local drought would be compensated under those higher prices.
What about the circumstances if both yield and price turn to the downside, though?
So this is where revenue insurance really kicks in. I was just looking at county level averages for corn, irrigated and non-irrigated in Kansas, and RP at 70-75%, 75% is going to trigger about 25% of the time, and that's a lower estimate because I'm using county level yields, but that happens fairly often. It's in 1 in 10 years for irrigated.
And then you turn it back around. If prices fall off and yields go to the upside, given that we receive some decent rainfall in this growing season.
Right. And this is where standard crop insurance, standard revenue protection policies probably wouldn't kick in. So in the extreme case, you could look at a year where you have normal yields and prices go down. It's about 1 in 30 years where prices actually go down enough to trigger your standard revenue protection policy. So in other words, a 25% price decline between February and the fall is very unlikely. It does happen. 1 in 30 years is the number that I've seen. And this year is certainly I don't think anything would surprise me this year. But this is a situation where crop insurance usually isn't going to help a producer. I mean, you could look at there's other combinations there that you could think about. Yields, you have a pretty decent year on yields, prices go down, but they don't go down that much. That's probably going to cancel each other out. So if producers don't want to miss out on this upside, if prices go down between where they are right now, but yields are all right, you have to look beyond crop insurance. And there's a cost to that. So you could use high coverage policies or shallow loss is another term. So the SCO, supplemental coverage option, enhanced coverage option, those are much more likely to be triggered by price declines. You could also do forward contracting, hedging. So there are options there, but it's not going to come from your standard revenue protection policy.
And there is an expense associated with those extra considerations there.
I would say the expenses in both time and money.
Well, Jenny, then there's a lot that the producer can contemplate here, but it would appear that a producer will benefit from the coverage itself in a broad context, irrespective of their take here.
Right. And I think with all that's going on in the world and locally right now, it's good to know that we have these high prices.
And, of course, one would have a dialogue with their crop insurance agent as we approach that deadline to firm up the final details on individual coverage. But, Jenny, you'll be posting information on the agmanager.info website come early next week and actually illustrating what option might be the most suitable for a given producer in their given situation and expectations.
Right. So I want to provide some information that helps a producer think through the likelihood of different price and yield outcomes. But I also want to look back historically and see how often a crop insurance payout was triggered by either price or yield, how often we had revenue, price and yield that was above average, and how often you fall in that sort of in-between area where you're below average, but payouts aren't getting triggered by your standard revenue protection policy. So, knowing how often you land in there is a useful tool for thinking about adding on some additional protection, especially against price declines.
Yeah, history can be a good teacher here, that's for certain, as the numbers will tell us. You can find that, again, starting next week on agmanager.info, so make a note of that and take full advantage of the information Jenny's providing. On your crop insurance considerations, once again, the deadline for enrolling is a week from this coming Tuesday, March the 15th. Very important as we head into another crop production season to make good decisions there. Jenny, as always, thank you for being along with us. We appreciate it.
Thank you.
She's Jenny Ifft from the Agricultural Economics Department at K-State, Research and Extension Risk Management Specialist here at the university. And while we've a moment here, a quick related reminder that K-State Agricultural Economics will be hosting that Risk and Profit mini-conference next week online, and it'll discuss the agricultural impacts of the Ukraine-Russia conflict, what it means for producers here in Kansas and the U.S. These will take place over the noon hour on Monday the 7th, Wednesday the 9th, and Friday the 11th via Zoom. On Monday, they'll cover the macroeconomic impacts and the production and trade effects. Wednesday, the implications for the energy markets and the effects on the fertilizer market and prices. And then Friday, the grain and livestock market ramifications. It's a free program, no fee involved there, but online registration is required, and you can find out more about that at agmanager.info. But again, a mini-conference, if you will, over the noon hours on Monday, Wednesday, and Friday of next week on the situation in Ukraine, what it means to our agricultural sector and you producers. This is the K-State Radio Network. Topping off this Agriculture Today, it's our weekly segment on Kansas agricultural weather featuring K-State Research and Extension meteorologist Chip Redmond. Well, Chip, we had a taste of spring this week around Kansas. We're not done quite with colder weather yet, but it was obviously quite warm.
Yeah, very, very, very warm temperatures to start March. Abnormally warm. And if we didn't set a record in many places in central and east Kansas, we missed it by a degree or two. And really not the optimal way to start March after a very dry winter.
That in part because the evapotranspiration rates pick up considerably with these kinds of conditions?
Yeah, with really warm, dry air, we're sucking any moisture we had left in the topsoil out. Eastern Kansas really benefited a lot from snow and precipitation over the last few weeks, and you can literally watch almost hourly that surface moisture drop in the topsoil. It sucked it out, and we had sun too, and it all compiles. Thankfully, we haven't had a whole lot of wind, but it was just really abnormally dry and abnormally warm for this time of year.
And very little, if any, moisture at all in the state this past week.
Yeah, there wasn't anything at all across the state. And so our deficits continue to grow another week. Our average precipitation is increasing on a weekly basis. So with no rain this week, the far southeast lost out and went below average by about 0.4 of an inch, and western Kansas, anywhere from 1/10 to 2/10 of an inch of rain is what we expect for this week. And so we didn't get that. So we add that to our departure, and we're growing our departure even more. And we're up to, just in the last 120 days, departures of 5 inches in the southeast to an inch and a half in the west. And some of those areas have not received any rain over the last 120 days.
It's becoming harder and harder to catch up, given what we expect in the way of an outlook. And to that point, looking to the weekend, there are expectations of cooler conditions and some moisture. But once more, that's pretty spotty, isn't it, Chip?
Yeah, we get a really strong cold front coming through Saturday that likely is going to create some extreme fire weather, especially for the central and southern part of the state. And it brings in much cooler air for the rest of the weekend and into early next week, even below average temperatures, really. The precipitation chances, there's a little bit of a chance in far east Kansas on Saturday. And then Sunday into Monday, there's a chance of snow. Some people have talked about higher probabilities of snow in eastern Kansas. The trend has been it's going to shift eastward. And so I just don't buy into it much. We're going to probably see some precipitation in far east Kansas, but very limited, maybe a quarter inch to maximum half inch in the far southeast liquid equivalent.
We keep pointing an accusing finger at La Nina, which has been well entrenched. There is continued speculation, though, that La Nina may be showing signs of cracking, of breaking down. What are you hearing?
Yeah, it's been ever so slightly warming up because La Nina is colder waters in the eastern Pacific. And so as that warms up, it would typically have a less influence. We're not really expected to get out of La Nina until the April, May, and June time frame. But basically a weakening La Nina means that the pattern that we have right now, which has been moisture to our east, tends to shift west. Unfortunately, this time of year, we get more frequent cold fronts, and we aren't able to tap into that Gulf moisture just yet until later in the spring. So that would mean an increased likelihood of wind events, big temperature swings like we're going to see this weekend, and not a whole lot of confidence in precipitation outside of the far eastern edge of the state.
We always appreciate your time and the insight. Thank you, and enjoy your weekend, Chip.
Yes, you too.
Chip Redmond, meteorologist, K-State Research and Extension, filling us in on the Kansas agricultural weather scene. Likewise, we bid you a good weekend, and thanks for joining us right here. Eric Atkinson for Agriculture Today. This is the K-State Radio Network.